Hello everyone, this is Professor Kent. Today's recording is homework for chapter 12. The two questions that I promised that I will record. I'm recording those two questions. The first question is 1210 and it is exercise 1210. And the first part they're asking you to prepare a schedule showing intangible section of Tennessee Statement of Financial Position at December 31st. And it says show supporting calculation in a good form. So we needed to show how we arrived to the numbers that we arrived. So when you're asked a statement of financial position, the first thing you're going to do is you're going to have to put it in the name of the company. The name of the company is Tennessee Corporation. And what are we doing? We're preparing a statement of financial position. Statement of financial position. They don't want you to do everything, they just want you to do portion of it, and that's in this case the date is that December 31st 2023, and we're only going to do the intangible assets. So we're only going to do a section of intangible assets. When you do an intangible, we're looking at the first one. First one is a patent. The patent was purchased, so we are going to put the final number here. The final number will be put it in here, but we have to show how do we get that number. It's a net of accumulated amortization. They said in the question a patent was purchased from Marvin Inc. For 1.2 million. So what we did is we purchased the patent. When did we purchase it? We purchased on January 1st 2022. In this case, this is the schedule that will support our answer that we put it in here. So we purchased for 1.2 million, and they said when did we purchase? On 22. It was estimated it was going to be for the 10 years. If it's going to be 10 years, my amortization per year is 120,000. They said then what happens is something happened. The patent was carried in Marvin's accounting record at 135,000. It does not matter what was carried. In our books, it was recorded at 1.2 million. And then when the Marvin sold to Tennessee on January 1st 2023, so what happens is we recorded 1 year's depreciation already. So we recorded this from January 1st to December 31st 2022. From there, what we're going to do is we're going to move to January 1st 2023. Something happened because of the recent event in the field. The Tennessee estimate the remaining life of the patent will only be 5 years. The remaining life only be 5 years. So what we needed to do is we needed to know what we're going to do, what was the value of our asset on January 1st. We could record our transaction. So in this case, the value of we have to look at the cost of the asset. The cost of the asset is 1.2 million. We already taken an amortization, accumulated amortization for the first year, which was 120,000. The net book value of the asset, or a carrying value of the asset, is 1.8 million. And then what they said is the asset only be amortized over the 5 years. So divided by 5 will give me an amortization expense, and that amortization expense will be for that amortization expense will be 216,000. So that will be the amortization. So that will be my amortization that I will have on the year 2023, and that will be for the 16,000. And then what are we left with? We'll have a net carrying value of the asset that is on December 31st 864. When the amount they're looking for is patent net of accumulated amortization is 864. That's what that's what the carrying value is from the schedule that we just prepared. So now once we done the first one, I'm going to erase this part, and then we're going to go to our next one and see what my next intangible asset that we have in the next one. So in this case, we have a franchise. So we got a franchise. We needed to record the net of the amortization. So we are going to have, it is a franchise, and that is net of accumulated amortization. We wanted to know what is going to be, again, you have to do a schedule for it. And the question is saying that franchise was purchased from Burr Inc. for $290. So we purchased, the purchase price was $290,000. That's what we purchased. When did we purchase it? We purchased it during 23. So it's somewhere in 23 we purchased that. Then they said that as a part of the deal, Burr must also pay 5% of the revenue from the franchise operation. Revenue from the franchise was 1.4 million. So what happens is that we wanted to know how much should we record as a revenue as a franchise. So what happens is we have a revenue in this year 1.4 million, and what we had to do is we had to pay them 5% of that. So what is the 5% of that we had to pay? The amount is going to be that we have to pay is 247,000, I believe. So I'm just going to do my calculation. So 140,000, 1.4 million, multiply by the 4%. We have to pay them, 70,000. So we had to pay them $70,000. So that's what we had to pay them. And this is in other words, it's an expense for the company. What we have to do is we have to pay that expense to them. So I'm going to do it one more time. I don't know if my numbers were right. It's a 70,000, and then that's the expense we have to pay. Then what happens is that they said Tennessee estimate the franchise useful life of franchise is 10 years, and it takes a full year amortization in the year that we purchase it. So what we have to do is we take the full year amortization. We wanted to know how much did we buy it. So we bought the franchise for 290,000, and the life of the franchise is 10 years. So we have to record 29,000 and amortization for that year. We need to remember also, because they're asking us to prepare an income statement, we're going to have an income statement too for that when we report our December 31st. So we bought the asset for 290. We have an amortization that is my accumulated amortization is minus. So the value of our franchise is 261,000. So the value of your franchise is 261,000, and then this will give me a total intangible assets, and that will be, if I add both numbers together, 1125, that will be my intangible assets. So we just have to, I'm just going to write it here, amortization on franchise, so because it will help me do the next one. 29,000, we have an expense that we have to pay, which was 70,000. So let's do part B. So let's do part B. So what is Part B? Part B is asking you to do an income statement, and if you look at number 3 is research costs. These are my research costs. If they're research costs, they will be expense unless the 6 criteria is met for the development cost. Otherwise, it will be recorded as a research expense. In this case, we don't know what it would be. So in this case, how do we know that what we are doing, we're preparing an income statement. When you have an income statement, the first thing you're going to have a revenue. With the only revenue we have is the 1.4 million that we are told in the question, revenue from franchise, and that is 1.4 million. That is my revenue. And we have an expenses, we have a lot of expenses. What we did is we calculated the amortization expense for 2023 on my on the patents that we have. So we have an amortization only for the 23, because this income statement is for 23, and then that was 216,000 that we calculated. You can go back to the part A. When we did it, you could look at the amortization expense for what, for my patent. So we also had in 2023 we have a franchise amortization on franchise, expense on franchise, and that was franchise, and that was $29,000. And we also had to pay a payment for the 5%, the 5% pay, the expense that we have on the franchise on our revenue. We have to share our revenue, that becomes our cost, and that is your $70,000. So, and then these are all my expenses. We also have a research expense, and that expense is 247,000. So what we're going to do is we are going to add up all the expenses. That is 247,000. So we're going to add up all your expenses, and then difference between those, if I add up all the expenses, I don't have a number. Just give me a minute to record the number. 216 plus the 29 plus the 70,000 plus 247. I have an income. My expenses are 562,000. My income, in if that's the only one, increase in income is the difference between the both. It is 838,000. So that's what it is. So that will be increase in income. The next part of the question is C part. The C part of the question is how this is different if the company was following an IFRS standard. If it's a public company, they will be following an IFRS standard. The research cost, if the 6 criteria is met, they will capitalize this expense. So they will capitalize it. If they capitalize it, they have to record an amortization on that development cost that they capitalize. And then we are not given any information how much to amortize the life of this development cost, so we cannot do an amortization. At this point, we know that if it's an IFRS company, if the 6 criteria are met for the research cost, they will be capitalize it. If they capitalize it instead of, they will capitalize it, and then if they capitalize it, they have to record an amortization on that. But we are not given any details on that. The next question that I wanted to do is 1221. The first entry is to prepare the journal entry to record the record the purchasing of this purchasing this business. So in this case, what happened is that we purchased the net asset. When they say net asset, your asset minus liability is called your it's a net assets. So what we did is we paid 450 plus the 50,000 cash, 50,000 in the notes payable. So what did we get in return? We got cash, accounts receivable, inventory, land, building, equipment, trademark, accounts payable, and capital. This is their capital. We don't care what their capital, they're going to retain that. Then we needed to know what is the fair value of the asset that we are receiving, which is the current value is the fair value. They say everything else is same except your land. Your land is worth $60,000. So that's the fair value of the land. And the inventory is worth $125,000. So the value of the inventory went up. And they said the trademark is worth useless. So if they're worth useless, we will not be recording in our books. The receivable is shown as a net. So the net accounts receivable is your 102,000. And they told us in the question that we have an allowance For expected credit losses. Credit losses is 12,000. So allowance is a minus. So what we need is we need an accounts receivable. If I add these two numbers, that will be the value of your accounts receivable. And they also told us that we have an amortization on some of the assets. We ignore them. It's in their books. We record the asset at a fair value. So now we needed to do an entry, or entry will be we got the cash. The cash is a normal balance, and the cash will be a debit balance. The accounts receivable will be a debit, and the amount will be 104,000. So we will record accounts receivable $104,000. And we also have to record allowance for expected credit losses. Allowance for expected credit losses, and the amount is $12,000. So that's what we have a credit. So now going further, what else did we get? We got an inventory. I will debit my inventory, and that is $125,000. We got a land which is worth $60,000. We got a building which is $75,000, and we have an equipment that is worth $90,000. So these are my assets that we got when we took over this business. We also have a liability that we took over. In this case, my accounts payable is my liability that we took over, which is your $300,000. We paid cash. In the question they told us we paid $450,000 cash, and we issued a note. Cash was $415,000, and we have a notes payable that is your $50,000. So if they are asking you to do an entry, or entry doesn't balance, I add up all my credits and I'll add up all my debits. So the difference between, if I need a debit entry, the goodwill, it will be a goodwill here. So if I have a debit entry, it will be a debit. So take this number and take this number, you subtract it from each other. I will have a goodwill. The value of your goodwill will be $238,000. So that's the entry for the first one. Going further, they are saying assume that it is a private company, and this goodwill was the goodwill was part of the entity as a whole. So in this case, they're saying it as a whole. So there, if it's as a whole, what we needed to do is it's a private company, and how do we test for goodwill? It's tested for impairment. They're saying that one more year was gone by. Amount determined that the reporting unit, so this is a unit, the carrying value of the unit, the carrying value of the reporting unit is, they're saying it is 500,000, and then that also includes the goodwill, and then said that the fair value of that was the fair value of the reporting unit. The fair value of the reporting unit was 450,000. So the value of the reporting unit went down. If it went down, that means the it is impaired. We need to, if it's gone down, we need to do an adjusting entry. What will be my adjusting entry? Difference between the both is your $50,000. The entry you will have to do is loss on impairment, and then we have accumulated impairment loss, and it is on a goodwill, and the amount here is $50,000. So you have to test it with a fair value, and this is in case it's a unit, so it's on its own. So they're saying now part C, we have to repeat what you did in part A, except that they paid cash. All they paid in cash was 204,000. So in other words, you are going to do, your entry is going to change. Everything else is going to be same. How is going to be changed? In this case, the amount is going to be changed. So what are we going to look at it? You could have a negative goodwill or you could have a positive goodwill. And the one we just, in part A, we had a positive goodwill. Now we're going to have a negative goodwill. When you have a negative goodwill, what they told us in the question, everything is the same except what we did is we paid instead of 415,000 and the notes payable, we only paid was 204,000 in cash. So again, I'm going to add up all my debits and then all my credits. So what we're going to do is then either I need a debit entry or I need a credit entry. In this case, if I take my 300 plus the 12 plus the 204, it is worth 516,000. That's my credit. And if I add up all my debits, 75 plus the 114, 125, 60 plus 75, and plus my 90 will give me 539,000. So I take the difference between the both, 516. I need a credit balance. When you need a credit balance, what we call it, we don't call it goodwill, we call it a gain. So this is a gain is 23,000. So gain goes on to your net income. It goes onto your income statement. So if there's a gain, it goes onto my income statement. If you need a positive number, a positive number will be your goodwill. So it will be a goodwill. If it's a goodwill, it will be tested for impairment. Tested for, if it's a gain, if you need a credit, it's a gain. So let's look at our part D and then we'll do part E. So what is my part D is telling me to do? Based on part A, then they use a public company. So in this case, it's a public company. We had to go back to part A, that's what we did, and we needed to do an entry. I know we needed to look at it, what my entry is going to be, but they're using an IFRS in this case, and it's a reporting unit too. They are saying the carrying amount of our unit is 500,000. If you're using an IFRS, what we have is we have something called value in use. And what is the value in use? It is given to us in the question. Value in use is 475,000. And then what we have is fair value minus your disposal cost, which is, they told us, which in the question, it is fair value minus disposal is 450 minus the 25,000, and what that will give me, that will give me 425,000. When you have IFRS, we will look for a recoverable amount. A recoverable amount is the amount higher, the higher amount of both. In this case, the higher amount is 475, and we take that amount that we have a recoverable amount. In this case, the recoverable amount is 475,000. It is impaired. Yes, it is impaired. How much is impaired by? 25,000. You debit the loss on impairment. Credit will be your accumulated impairment loss of $25,000. Then we're going to go further to do part E, what they're saying about E. We're going to go to part E. It's saying part E, discuss factor that Joe may consider deciding to pay total and 465 altogether. So we paid, in the question, we paid 415,000 cash. We also have a notes payable which is $50,000. So if we paid more than what the company's assets are worth, what we did is we had a goodwill. Goodwill is 238,000. In other words, if the company pay more than what the company is, if we pay more than what the business is worth, we have a positive goodwill. If we have a positive goodwill, we're paying for the reputation of the company. That's what we're paying for. Since I promised to record the both transaction, I recorded, sorry, not both transaction, to record both questions. This is my recording. Thank you for listening to me. Take care and bye for now.